Okay, so when it comes to setups, trading futures, of course, we want to look for opportunities in which we can, one, have a higher chance of winning, correct? So we're talking about a futures trading setup that allows us to be able to profit, okay, and lower our risk in the trade that we're taking, whether it's taking shorts or longs. And I trade supply and demand. So if you're a first-time viewer, there are tons of videos where I go into detail about the strategy. But let me say this first and foremost. Try to make your trading as simple as possible. But the key ingredient to increasing your win rate or having a higher win rate is bringing in multiple folds of confluence into the picture. The more confluence you have, the higher the probability of a trade working out. Now, when it comes to supply and demand, simple concepts. Supply is nothing more than aggressive selling, and demand aggressive buying. But there is a systematic way of going about doing this. The number one thing, let me say, that you should stress of importance when trading is understanding the structure of the market, and that's just understanding the flow of the market. If we're trending in any particular direction, whether up, down, and then if we're moving sideways, try your best to stay out of that type of movement. But I'm just going to show you by example what I'm talking about here. I'll try to cover two trade setups, one supply and then one demand. But just pay close attention. The biggest part of what I want you to understand is bringing in multiple folds of confluence to be able to increase or have a higher chance of a higher win rate versus a lower chance of one, okay? And we're going to talk about those things that I'm referencing when it comes to confluence, all right? One, marking up a higher base zone from a higher base chart. Doesn't matter if you trade, like I say, always range, base, tick, volume charts, whatever it is that you are consistently winning from those charts. Try your best to look out at the bigger picture and mark a zone up off of a higher base chart. And then you're basically taking a top-down approach or step from a higher base chart down to a lower base chart. People always ask me why the lower base chart. It's simply because we want to try to get into a more precise entry point. You should know by now that if you're taking trades or looking for opportunities to take trades from a higher base chart, marking up zones that way, there, just for example, there could be multiple points in one candle, all right? We want to get in at the best opportunity on a lower base chart because it's going to get us in where we need to get in at and not incur or take on as much drawdown before the market tends to move in our direction. What do I mean by looking at structure of the market, and how does that help us increase our win rate? That increases the chances for one of us forming a bias of which way the market is moving so that we can take trades in the same direction in which the market is moving. Why would you want to go against the grain when the market is bullish, breaking structure continuously to the upside and then then pulling back? You want to go long there versus going short, okay? So let's take a look here. I'm going to show you an example of what I'm talking about when it comes to structure of the market. When I first get in front of my charts, I'm just looking forward to see what is the movement, the flow of the market. It comes with experience, and in time, you should be able to get in front of your charts or sit down in front of your charts and be able to depict the movement or the flow bias-wise, which way the market is moving. This type of structure right here is showing me the market is just moving to the downside. You should be able to see this: a high, low, a lower high, lower low, lower high, lower low. So we're breaking structure continuously to the downside. We broke here, came down and broke here. Okay, so we're moving to the downside. When I see flows like this or movement like this, I'm only looking for opportunities to go short. Okay, I'm talking about the strategy because this is what's going to help. But confluence is the biggest factor in trying to increase, that win rate so that you can become profitable. Now, let me give you a piece of advice, a tip that's going to aid you in also having a chance of sustaining profitability, okay? Taking one, no more than two setups a day, all right? I know beginner traders out there, they're not going to quite grasp this, but in time you will see, because you'll see the more time you spend in the market, okay, taking setups, that eventually you're going to have more losses than wins, okay, because you're trading too much, all right? Over trading is a huge problem when it comes to beginner traders, they get into the markets. Yeah, you're testing, but you have to treat trading and come up with a plan and follow that plan. So if you do that regimen each and every day and you stay within the parameters of your trading plan, you're going to see that your trading is going to get better and better over time because you're limiting the number of trades. So do your biggest part for yourself, and that is, even though you're doing demo or simulation, trade as just as if you're actually trading with your live money. Get yourself in that psychological standpoint or mind frame of even if you're in simulation, trading, okay, all right, or if you're trading with a small account, trade just like you were if you're trading live. All right, so here, if you take a look here, we're moving to the downside, right? So if we're moving to the downside, always remember this. As long as you're breaking structure lower, look for opportunities to go short. Breaking structure higher, look for opportunities to go long, okay? All structure is, or what I mean when I say breaking structure, is like right here, the market made a low, even though it kind of pulled back, there are multiple swings within this leg, right? Picture this in your mind, because the moment the market turns and starts taking out these little minor swings to the downside, this is you can see it right here. Let's take a look. This is the lowest point when the market was moving down. So this is a major low. All these swings pulling back here are minor swings. So if it comes down here and takes out this low here, that's considered major structure. And when the market breaks that area, somewhere on the pullback, you look for your opportunity to go short. Just like right here, the market pulled back, some minor swings to the downside, major low here. This is the last low that it made before it pulled back and then broke again lower. Okay, so then we can look for something to happen on the pullback. Okay, then the same thing here, pulls back again, minor swings to the upside, it broke structure below this area here at 19,440. So we can look for something to happen on a pullback to a key area to go short. That's all we're doing. So pay close attention to right here, because now that we've identified the structural breaks in the movement of the market, which is trending to the downside, it broke structure here at 19,440, just like I said. These are minor swings to the upside. We're starting to, the tide changes to where we're making lower lows and lower highs below. We break below this area of structure. Now, this is a big thing that I always talk about. Look to see, this is a major piece or major ingredient to the recipe of the strategy in which I trade when it comes to confluence, okay? Because I'm using two charts primarily to increase my chances of a trade working out, but I'm also bringing into the fold or ingredients into the recipe, all right? Think about it like that. Confluence, all right? This, for one, confluence is what I see the market breaking structure lower. My bias to the downside, okay? Number one, okay? We broke structure right here, 19,440. Then I'm looking back to see that one of the biggest parts of what I do before I mark my zones is there any area, okay, in which there is a supply zone on the way down that was created with the market broke structure to where there is a gap at, where there's an unmitigated zone at. Lots of people who are first-time viewers are probably saying, what does that mean? That simply means, is there an area in which the market did not touch, okay, on the pullback at some point, all right? So every little pullback that it made, okay, as it was moving lower, did the market at some point pull back and test that last bullish candle to the upside, like right here? Push down, pull back, push lower, pull back. Last bullish candle to the upside. When it broke lower right there, okay, this red candle that broke below that area, the next one came back, the wick of it tapped the bottom end of that green candle. So that is a tap. That means that there's no gap there, all right? I cancel that zone immediately. I'm looking for fresh zones, okay, or fresh unmarked areas in which the market hasn't tapped yet. Pushes lower again, pulls back, okay, that's the pullback. Last bullish candle to the upside. That bearish candle broke below that last last bullish candle to the upside. The next candle that closed to the downside, before it closed, it came back and wicked the bottom end of that bearish candle to the upside. It's tapped. No gap there, meaning that it's not an unmitigated area. Okay, we push lower. Before we actually get the break of structure below here, take a look. Pushes down, pulls back, aggressive selling to the downside, but pay attention to that bullish candle right there. When it pulled back, the next candle, or not say the next candle, but the candle that closed below that bullish candle to the downside, which was this one right here, there's a small variance of a gap or small area of gap from the bottom end of that bullish candle, the wick of it, to this bearish candle right here, or even the pullback right here. There's a small gap right there. Unmitigated gapped area, okay? This means that basically what happens is closures either on a pullback to the upside or downside to where the market closes the gap at areas of imbalances, okay? That's what it is. It's an imbalance. So if the market hasn't tested that area, The likelihood of the market testing that area is it has to, all right, at some point it will happen. And when it does happen, we've got to be on high alert to see, okay, unmitigated, gapped area, part of the ingredient to the recipe, to the strategy. We get the break of structure. We're building up confluence to be able to take a trade going short, all right? The market pushes lower, it pulls back. Even on a pullback, it leaves still a gap in that area. Continues pushing lower, it pulls back. Why am I interested at this area? Again, because we broke structure on a higher base chart. That is definitely going to increase my awareness of this trade setup right here. Now, typically speaking, I'll say, well, if it's the latter part of a leg, which it is on the push to the downside where we had to break a structure right here, I would be looking for higher areas for the market to possibly test. But there's no further area. There's no higher areas. It was already, the gap was filled here, the gap was filled here, the gap was filled back up here. All these areas have already been mitigated, okay? Meaning there's no imbalance there. There is an imbalance resting right here. There's a gap. It's unmitigated. So when the market comes back to this area, I've already got it marked off. I'm going to be interested, but I'm not looking to take my trade off the higher base chart. This is where another layer of confluence comes into the picture, into the play. This is where I'm going to scale down or move down to a lower base chart. That's the last portion of the setup, or in trading futures for me when it comes to trading, say, for example, the NASDAQ 100 futures. Same type principle, same concept, same strategy I can use no matter the market, okay? All right, it doesn't matter if I want to trade gold, if I want to trade oil, if I want to trade any means of grains or meats. It doesn't matter. I use the same strategy over and over, same principle, same concept, okay? The market pulls back to the supply zone right here. When it taps, okay, and what I love to see, another layer of confluence, is when the market goes back up there and it taps the zone and doesn't close inside the zone, but we get a wick at the zone and then it moves away. My awareness, my eyes are open. This is where I move down to a higher base chart. To a lower base chart. Let's go down. I'm going to put this on all charts so we can see it. This was on the 28th of August, supply zone. Now let's go to the 20. I'm moving down to my 24 range chart in which I take my trade entries from the NASDAQ, okay? Okay, so you see this big rectangle box, okay? Guys, I know I talk about these setups because, look, here's the thing. Lots of people, even if you've probably been, I'm not saying been, but everybody has, you go through school and whatever the case is, people have to see things multiple times. And the more they see it in repetition, the better they get at doing things, okay? And seeing it visually, because most people are visual learners, all right? Having to see things and then work maybe with their hands to be able to, those that work with their hands. But anyways, getting back to what I'm saying, this is a visual representation right here. So you see this rectangle box? That's the same one I just marked on the 120 range chart, that supply area, okay? It just looks bigger across on the 24 range now because we're down on a lower scaled or scaled down chart. Now, all we're looking for to happen here is a pullback to that higher base 120 range zone. It taps. Normally, what I do once we get here on the get back to that zone on the 24 range chart, okay, I'll look to the left-hand side. This is imperative. Take notes to see if there's a valid supply area, okay, in which I can look to take an opportunity to go short at on the 24 range chart here. Now, this is a valid supply area right here. You see it right here. I can mark up this little zone right here, okay, and carry it across, and we tapped. So we got a zone within a zone. We do, okay, a higher base zone and a lower base zone here. And on the 24 range chart, we also broke structure lower. See? Broke this low right here, pull back, broke structure. There is a supply area. Make sure 100% though. Give me 1 second. Let me blow this up for you guys, myself too, so I can see. Let's go over here, kind of blow this up a little bit so I can see it myself. Okay, so that is a break of structure below. There's a gap here, okay? So unmitigated, imbalance, resting there right there. The market hasn't come back after it broke below that last bullish candle to the downside. It didn't come back and fill it. I don't believe yet. Let's see. Let me make sure 100%. Okay, where does it test it? Okay, so it tests it right here. So we got a zone within a zone. All right, so here it is. What happens here, typically, I always talk about looking for the break and close of the candle, right? So if you're taking a trade maybe at 52, the market pulls back, hasn't stopped you out because your stop is going to be resting above that 62 area, maybe a couple ticks or a few points above that, and then it comes back down and it hits around about 46. So yeah, I mean, if you got in at 52, you probably picked up probably there 6 points there, and if you then maybe well, what happened is it turned back around and it stopped you out. We don't control the market as retail traders, and lots of times this is going to happen. And look, I've been there, done that, and it's a factor of what you have to, at this point, it's all about risk management, closing the trade out, right? But, and this is what you do, you know, when you see things like this unfold, is that when you start seeing bullish candles form back to the upside, and let's say it breaks above this area here at 19,457, go ahead and close the trade out unless you want to hold it. And by doing so, you've probably gotten out just a few points above break even. You're protecting your capital, you know, but you're not taking on a full stop where you're incurring too much drawdown. Or you can hold it and allow it to, you know, stop you out if you choose to, whatever the case is. But either way, I'm trying to show you is that the trade still works out. Sometimes we have to get back into the trade setup, okay? That's the way of just basically shaking the market, grabbing liquidity or stopping traders out because people started selling right here. But they were still ready to go short, okay? Because take a look. I'm trying to show you this. This was a beautiful still area to go short from. It's just the market makers weren't ready to make their move back to the downside. They're going to stop people out before they do so lots of times. But most times, the trade will go in the direction in which you were already in without coming back and stopping out. But every once in a while, this will happen to where, you know, the market will move in your direction, give you, you know, 6, 7, 8 points, maybe 10 points, and then boom, come back and stop you out. So you have to be smart when it comes to trading and cut your losses, maybe at break even, especially when you get that. Let me show you, for example, here. When you get that break and close of the candle, meaning this last bullish candle to the upside right here, this bearish candle to the downside, right around about 52, maybe you got into the trade right there. If the market comes back, okay, and it doesn't continue pushing lower, but it comes back with a bullish candle, the next candle, and starts to close above the candle that initiated your trade to go short. In this example right here, that bearish candle right there, it breaks and closes above that bearish candle, then go ahead, you can close your trade out to secure and to protect your capital, all right? But if you get a second opportunity to be able to go short, then take that opportunity is what I'm trying to say, because sometimes they're not quite ready to make their move yet, all right? And lots of times if you can get in on a second opportunity, that move is going to be very significant. Now, you should already know that it's going to be a decent move to the downside based on probability of what took place right here. Beautiful breaker structure to the downside. There's a aggressive area of selling. This is all based back on the higher base chart. And we have a gap back up the zone. It's unmitigated. There is an imbalance resting right there. So this is where they tested that area twice right here on the lower base chart. I'm going to show you again. And the move went from 19,467 all the way down to 19,278. Big move, okay? So just imagine capitalizing on that move right there. All right. So this is what I would do. All right. If this happened and I noticed, I just showed you to where the market was in our favor and then turn back around and close back above. I talked about this in videos before with a bullish candle above the entry candle or the confirmation candle, which would have gotten us to the trade. I'm getting out. And then I'm going to wait to see back in this area because we're still in that zone. We're still in that higher base zone right here. The bigger box, okay? We have not broken above or broke through that area, all right? Because that area, you're looking back at the chart, is right here. You see it? Now, what we don't want to see it do is pretty much, you know, break and close into the zone, and we don't want to see it break above the supply area there, okay? So what I'm typically at that point going to do, okay, I'm going to still look to the left-hand side. I'm going to say, okay, is there any other areas of supply in which the market could stop at or hold at and continue, you know, pushing to the downside? Well, right here on the 24 range chart, right here at 19,472, it didn't quite get there. And there is an unmitigated gap or a gap back at that zone right there on the lower base chart. It didn't get to it. So we're still inside the higher base zone. We haven't broken through it. The trade is still valid if we can get, you know, a second rejection, right? So what I'll do is, because that didn't happen and we didn't get a tap inside of a zone on the higher base chart or the higher zone on the lower base chart, okay, we did right here, but the market broke through it, came back, took us out, okay? And there's another zone resting above, but we didn't tap into it. So what would I do right now? What I would do is this here. I would wait to see if we can get a structure break to the downside. Okay, well, take a look. It starts to turn. It broke above here, came up here, still valid. It pushes down, pulls back, break structure here on the lower base 24 range chart, leaving behind what? A supply area right here. All right, take a look. Aggressive selling, breaking a little bit of small area structure there to the downside. Going to put supply area on the 24 range right here. Okay, there's a very small gap. Let's get this right. I'm going to blow it up for you so you can see it. Whoops. Okay, right here. Okay, see that candle right here that broke below that last bullish candle to the upside right there? The market didn't pull back or tap back into that until we got the pullback. After the break right here, structure to the downside, pull us back. Now we're still inside the bigger 120 range supply zone we saw, beautiful area, and it just formed a structural break to the downside, leaving behind a beautiful new area of supply. Now, what do we get? We wait for the break and close. Now that we tapped into the 24-hour supply zone that's freshly created, wait for the break and close of the candle, 450, 19,450, and then we're aiming to pick up our 20 points or more, but typically I'm aiming for the first 20. If you got multiple contracts, you can take majority of your position off and allow a contract to run. Okay, simply put. Now for all those that like trading the higher base charts, yeah, you could do something like this if you choose to. The market taps into the higher base zone, and then you can basically look for a 1-to-1 or 1-to-1 R or 1-to-1 risk to reward or whatever the case is, and maybe do something like this right here. You get to tap into it, you start to get the break and close below, and then maybe do something like this, aiming for a 1-to-1. Okay. All right, and then maybe take out here at 19,407. But I like to really pace myself on the lower base chart because I like to see price action movement. Okay, but again, I'm aiming for at least 20 on the 20 points on the this is NASDAQ 100 on the lower base chart, and maybe allowing a runner to run. But if you're in with multiple contracts and you take all your position off and pick up 20, then you've done well, depending if you trade the micros or the E-mini. But yeah, you could do that here on the higher base chart using the risk to reward tool, but you got to be very careful because again, you're trading from a higher base chart solely if you're doing this. And there are a lot of points in between one candle. So one candle could be like right here on this, let's just say this bearish candle to the downside right here at 19,438, all the way back up here to 19,438, all the way back up here to 19,468. That's 30 points right there. So be careful in that one little candle there's 30 points. Okay, so that's a lot of movement that could take place in that one candle. This is why I like moving down to a lower base chart and using that confirmation and waiting for another zone to be created within the higher base zone to look for an entry point with the confirmation and rejection and break and close of the candle. So pulls back to the zone, break and close of this last bullish candle to the upside around about 450, about 19,450. You're going to get to the trade and then aim for your 20 points or more. You can pick up more than 20 points. I'm not saying just take out at 20. I'm simply saying maybe pick up and take out your first contracts, close most of your positions off at 20, and then allowing the remainder to run. Okay, but it's up to you how you trade. Now, if you're looking for more points, that's fine. But I'll also talk about as well that you can aim for gaps below, and we do have. Let's see. We'll get back here to the higher base chart. Okay, be careful because we do have a gap. Let's see. No, we don't have a gap right here, so the market could possibly come down here. But anyways, aim for the first 20 is what you can aim for, or you can aim for liquidity down here at the low right here, which is at 19,388. If you can hold that trade through, and then it definitely comes down there, okay? Because this is a beautiful area of higher base structure being broken on a key area of unmitigated, untapped supply on the higher base chart, so it goes down there. So I'm just want to show you, typically my favorite type of setup and what I'm looking for, but the ingredients into the setup of how it works out in your favor if you know how to trade it correctly. But it's all about, the biggest part of this is about confluence. The more confluence you have on your side, the higher the chances and the higher your win rate will be in the trade working out in your favor. Hopefully that makes sense, okay? But outside of that, that's all I really wanted to cover and share with you guys today. Just bringing, basically the setup to how I trade and to explaining to you. I'm not telling anyone to trade like me. Whatever works for you and you're consistent, you're profitable today, stay with it. I'm telling you, because I see too many people that are shaking away or moving away from things that are making them money already, and then they're trying something else. Look, if you're making money, be consistent with it and build from there. Okay. All right. Talk about that. All right. I'm consistent doing this, and this works for me. If you got something else that works for you, then do that. But anyone that is looking for something to possibly kind of learn or understand, watch the videos here on this channel. You can watch and educate your own self. The strategy is not hard at all to be able to grasp, understand, and learn on your own. But for anyone that's also wanting further detail or more breakdowns and trades that I take, ones that I post over on our Discord, first and foremost, the Discord is down below in the description. Scroll down. You'll see the top link. The first link there is the Discord link. You can join, okay, the Discord. Come over and join us on the Discord. Or you can also, the second link is to become an elite member. You say, Mike, what is that? That's where I go into deep detail about trade setups that I take so that you further understand and learn more so about profit target areas, the stop losses, where to place them at in relation to the strategy, okay? And I break these trades down so you grasp an understanding about what I was looking at structure-wise in the market before I took a trade, leading up to the trade, what I was thinking about while I was in the trade. I break those things down so you can understand the mindset. When you understand the mindset of a trader and the trades that they're taking, it helps you understand and be able to draw a better picture and have a conclusion as to why that person took that trade, grasp and understanding, and more so the strategy. The link to become an elite member to gain access to all the trade breakdown videos, as well as the video playlist and a great video that I did covering market structure. You might want to take a look at that because I go into detail about market structure so that you can, it's basically like an elementary 101 type video that breaks structure down. You click on the link below in the Discord, down in the description portion of the video, a link there that says become an elite member. 2 tiers will pop up. Make sure to choose the second one for $6.99 because that's all it is. Very inexpensive fee, $6.99. Basically, what you're doing, you're supporting my efforts as a content creator. That's all you're doing. And in return, I'm giving something back as far as perks and rewards. It's all through YouTube membership program. So if you're interested, the link is down below. That's up to you. But anyways, if you're not a subscriber, and go ahead, click on the subscribe button right now. Okay? Right now. Do it. And make sure to turn on all your post notifications so you don't miss any other uploads or content here on the channel. But outside of that, I hope everyone has a fabulous weekend, the rest of your weekend. And if you found value in today's video, please make sure to click on the like button, that thumbs up button. Go ahead, click it right now. Appreciate it. Take care. See everyone in the next one.